Good evening, everyone. Welcome back to one more interesting session of financial management of CA Inter uh, for the November attempt. Uh, I hope all of you are doing good. Studies are going fine. Ready to face the exams just in maybe next couple of months. Uh, Today we'll take up an interesting topic again from a very interesting subject of financial management. We have this chapter that we are going to discuss today, that's financing decisions, that's targeting the capital structure. So the capital structure portion will be divided into two sessions. One session we are going to have it today, and another one will be on Saturday as well. Yeah. So in today's session, we'll get introduced about what is capital structure, how do we decide which capital structure to maintain, and some other basic things. And then in the next session, we'll take it towards the capital structure theories. Okay. In the last few sessions, we have learned about certain ratios. We have one more session of ratios or revision of ratio and capital structure. That's probably, if I'm not wrong, in the end of August itself. So there we'll be taking up more questions and any sort of doubts that you might be having in the module. Okay. So right now today, let's begin with the capital structure part. To begin with, let me just put in front of you a scenario. Let's say we have a company, we've got a company that wants to raise 10 lakh. Now this 10 lakh is to be raised by the company. This 10 lakh is to be raised by the company by three plans. Let's say company is having three plans to raise the money. One plan is to raise the entire 10 lakh by way of equity shares. Another plan says, let's raise the funds and in the ratio of 50-50, which means 5 lakh equity, 5 lakh debenture. So in total, 10 lakh will be raised in that sense. And another plan 3, which talks about raising 2 lakh through equity, 4 lakh by debenture, and 4 lakh by preference share. So in that way, we have got three plans available for us, which will tell us the various ways of raising those funds. Okay. Now, my immediate question to you, what do you feel? Which of these plans would be the best one? Which of these three plans would be the best one? Yeah. Which of these three plans would be the best one? Hiral, I got a doubt. Please share the question 2 of ratio practice sum. Hiral, I've shared it on the portal. You can get it from the PDF. I've shared the practice question 1 and 2 of ratio on the PDF on the portal itself. You can get it from there. Okay. So it is plan 1, plan 3. So it depends on the returns we are generating. Okay. Okay. Plan 1, plan 3. Perfect. Fine. Okay, depends on the returns we're generating. Okay, fine. So let's do one thing. Whenever we want to decide which plan is to be taken up, we always prepare an income statement for it, and we begin with the EBIT. We begin with the earnings before interest and tax. Because see, whichever plan you take, you may go for plan 1, you may go for plan 2, or you may go for plan 3. Whether you take debenture, whether you take preference share, how much sales you are going to do, what is your variable cost, what will be your fixed cost, that is never dependent on which plan you are following. It will be indifferent. Like you may get the funds from equity or debt or preference share. that literally doesn't matter because your EBIT is going to be a constant figure. EBIT is not dependent on these plans because EBIT is ultimately dependent on how good you are in terms of operations, how good you are in terms of the operations of the plant. So if you are good at operations, of course, it will be the best one thing over here. If you are good at operations, your EBIT will be very strong. Okay. Your financing decisions are never going to determine how much your EBIT is. So irrespective of your financing decision, EBIT should be a constant figure. So let us assume that EBIT over here in plan one, that is suppose 3 lakh for each of the plans. For each of the plans, they're saying that EBIT is 3 lakh. Now with the EBIT of 3 lakh, we are going to see what's the impact on our EPS or earnings per share. Interest, let us say we want to subtract the interest over here. In this first case, we don't have any interest. In the second case, definitely we do have the interest, which is 5 lakh into 10%. So interest amount would be 50,000. And in the third plan, interest would be 4 lakh multiplied by 10%, which is going to be 40,000. Okay. So we get a profit before tax figure of 3 lakh, 2 lakh 50,000 and 2 lakh 60,000. 3 lakh, 2 lakh 50,000, 2 lakh 60,000. That's the profit before tax in 3 cases. Then let us subtract the tax over here, tax to the extent of like 30%. So 3 lakh 30% is going to be 90,000 as the tax. On 2 lakh 50,000, we'll have 30%. So that's 7. Percent, that's 78,000. Okay, 78,000. Then we've got the profit after tax figure as 2 lakh 10,000, 1 lakh 75,000, and this is going to be 1 lakh 82,000. Okay, so we've got a profit after tax. I have to go to the EPS level, up to EPS level. So we'll subtract preference dividend. Of course, there's no preference dividend in plan 1. There's no preference dividend in the plan 2. But we do have preference dividend in plan 3, which is going to be 12% of 4 lakh. Now, 12% of 4 lakh is 48,000. That's 2 lakh 10,000, 1 lakh 75,000, and 1 lakh 82,000 as reduced by 48,000, which become 1 lakh 34,000. Now, looking at the net profit for equity shareholder, which plan do you feel is the best one? 2 lakh 10, 1 lakh 75, 1 lakh 34. Which plan do you think that it's the best? Which plan do you feel is the best one? Is it plan 1, 2, or 3? Can we decide looking at only net profit for equity shareholders? Can we decide which plan should be chosen by looking at just net profit for shareholders? No, sir. We cannot, because understand this 2,10,000 profit, 2,10,000 profit is going to be distributed amongst 10 lakh equity share capital. 1,75,000 is going to be distributed amongst 5 lakh capital and 1 lakh 34 is going to be distributed amongst 2 lakh capital. So we don't want that to happen. We cannot compare these three because you'll say the 2 lakh 10 is earned by 10 lakh capital, or I can say, 1 lakh number of shares. So let us consider the number of equity shares. Over here, the number of equity shares in the first case, it is 10,000. In the second case, it is 5,000. So not 10,000. This 1 lakh. The second case, it is 5 lakh. And in the third case, that's going to be 4 lakh. So now when we are going to divide this will provide us the EPS or earnings per share, because we don't want to look at the overall profits of the company. Overall profits of the company may be very huge, but what if you have a lot of shareholders? So we don't want the overall profit or the total profit of the company should be big enough. It should be big enough to, per share basis. It should be big enough for every shareholder. So for every shareholder in plan 1, we have an EPS of 2.1. In case of plan 2, we have a EPS of 1,75,000 divided by 5 lakh. Not 5 lakh, my bad. Shareholders will be 50,000, right? 50,000 and 40,000. So 1,75,000 divided by 50,000 will be 3.5. And in the other case, this is going to be 1,34,000 divided by 40,000, which is 3.35. Okay. 1,34,000. 1,34,000 divided by 40,000, yeah, 3.35. Okay, so now looking at EPS 2.1, 3.5, 3.35, which plan should be the best one? Undoubtedly, it is going to be this plan, sir. Undoubtedly, without any more discussion, we can definitely say that this plan, or the plan which gives us the highest EPS of 3.5, is the best one. Right? We can say that this is the best one. More EPS, right? But remember, I told you something in the first class. In our very first class, sources of finance, scope, objectives of finance, I've told you something, if you can recollect, that what is the objective of a finance manager? Is it profit maximization or is it wealth maximization? Can you recollect? What was our objective in finance as a finance manager? What objective do we hold? Do we want to okay, 1 second. Plan 3 has got, okay, fine. Plan 3 has got 20,000 number of equity shares, because this is 2 lakh equity shares, right? So this is going to be the EPS. You can say it's 1,34,000 divided by 20,000 equity shares, because 2 lakh is the capital. Yeah, okay, that's 6.7. And here we have, this was remaining same, which is 1,75,000 divided by 50,000, 3.5. Okay, fine. I just corrected it. Okay, so we can just recollect that our objective was wealth maximization, right? So coming back, our objective was never to profit maximize. We were looking at wealth maximization. Now tell me, when the EPS of the company increase, is it mandatory that the wealth of the shareholders will also increase? When the company earns good profits, is it going to guarantee you better wealth for your investor, for your shareholders? Higher EPS, will it lead to always, obviously, as a general sense, you can say the company is making good profits, wealth of shareholders will increase, but it is mandatory. But is it mandatory that every time your EPS is high, you will start getting a better, better wealth or a better valuation of your shares? Need not be so. Because understand, over here, plan one is the safest one. Plan one is the safest one. So investors will say that this is the less risky plan, and therefore, in case of plan one, the investor will have a greater confidence of uh, safety of their investment or security of their investment, and therefore they will assign a price to earning ratio of 15. Remember, in the ratio analysis chapter, we have done price to earning ratio. Price to earning ratio was market price per share upon earnings per share. Right. So price to earning ratio, we have seen that it was market price per share upon earnings per share. And this was a measure of confidence that the investors have on the company. Correct? I hope you are able to recollect that. So P ratio was the measure of confidence that the investors have on the company. Yeah. So higher this P ratio, greater is the confidence. So as we say, in case of plan one, since it is a zero debt company, sir, there is no debt. Since it's a zero debt company, there is no debt. Entire 10 lakh is going to be raised by equity. It gives a better security to the investors. It gives a better security to the investors. And we find that this P ratio of 15 is the highest of all. So investors will have a greater confidence in case the company employs plan one. If the company employs plan two, in which it is obtaining some of the funds by way of debt, the confidence level of investors will go down, right? And therefore, they will not be ready to pay a very high price for it. And for that, they will have maybe a PE of 11. So how did you get this PE? This is how to get this PE. That's a very long journey ahead, guys. So don't jump into the direct. We want to know how to get this PE. It requires professional practice. It requires market analysis, right? So a lot of things are there which you will learn gradually as and when you will cross over to CFI and beyond in your practical life also, right? So let us assume that this is a derived figure. This is a given figure to us. So if you are having this plan with some amount of debt, some amount of equity, then the confidence that the investors have in your company will slightly fall, and that will lead to like having a P ratio of 11. And plan three is the most risky of all because you're getting debenture, you're also getting preference shares, or over here I can say the capital gearing is high. Capital gearing is high, and therefore investors assign a very low P ratio to this because they perceive a great risk in this company. Okay, so all the three plans are raising the entire 10 lakh, but the financial risk that the company is undertaking is different for different companies. In case of plan one, it's the most safe one. There is less risk involved in it. There is almost no financial risk involved in it. Only the company is undertaking the operation risk. In plan two, some amount of financial risk is undertaken. In plan three, some amount of, again, great amount of rather, I can say financial risk is undertaken. And therefore, the confidence that the investor has is lower. And therefore, P ratio is assigned is lower. So we have seen that P ratio was market price per share upon earnings per share. So ideally, if I want to know what is the market price per share, that should be P ratio multiplied by EPS. Market price per share should be equal to P ratio multiplied by earnings per share. So P into EPS is the market price per share number. Okay. So let us get the market price per share in each of these cases. So in the first case, market price per share will be 2.1 multiplied by 15. That's 31.5. Then 3.5 multiplied by 11. That's 38.5. Then 6.7 into 5. That's 33.5. Okay. Now, Tell me under which of the plans wealth of the investors will be maximum. Which plan is helping us to attain the financial management objective of maximizing wealth? Which of these three plans are helping us to attain the FM objective, financial management objective of wealth maximization? Yep, tell me. Of course, plan two, sir. Plan two is leading to wealth maximization. Now, my question comes to you is when do you say that your wealth becomes maximized? Of course, when the market price is increasing, market price is highest. But what is the precondition? What's the prerequisite for your wealth being maximum? Right? The prerequisite is you're getting adequate return for the risk that you have undertaken. Okay. So understand that your wealth will definitely increase only if you are getting adequate returns, only if you're getting adequate returns for the risk that you have undertaken. Or the value that you arrive at, the valuation of your company that comes at, it will be highest at a typical point where the risk and return are optimum or they're balancing out each other, right? So over here, what we can say is as per the profit maximization funda, we would have chosen plan 3, but our objective is wealth maximization, and therefore we will choose plan 2. Okay, so take a note over here, guys. To decide which financing plan to be chosen, we should consider earnings per share of each of the plan and select the plan with the highest yield. But if they give you information about P ratio in exams, if you have the information about the P ratio, remember P ratio is a hint for you to compute the market price per share, and that should be your selection criteria for the financing plans. Okay, so that's the very first concept that we are covering in this capital structure, and that is we have to choose a plan which gives us the maximum EPS, and if we have P ratio, since our objective is wealth maximization, we should choose a plan that gives us the maximum NPS or market price per share. Okay, is that thing clear, guys? I hope this is crystal clear. Yep. Are we good with this introduction part? Yeah, guys. Yep. I hope, are we clear with this thing, guys? Hiral, yes. Are you as per the upon the approach is still pending? We'll take it up in the revision class. I hope this part is clear. So let's make it even more crystal clear with the help of question number 2. Let's take up the capital structure problems. I've already shared this questions on the portal. You can get access to it. So let's have a look at this question number 2 as of now. Let's read this question, guys. The existing capital structure of XYZ Limited is as under. We've got existing capital structure as equity shares of 40 lakh, retained earnings of 10 lakhs, 9% preference shares 25 lakh, 7% debentures 25 lakh. Then they say existing rate of return on company's capital is 12% and the income tax rate is 50%. Company requires a sum of 25 lakh to finance its expansion program, for which it is considering the following alternatives. We are having three alternatives to raise the funds. First, it is issue of 20,000 equity shares at a premium of rupees 25 per share. To understand, premium of rupees 25 per share, face value of the bond, face value of the equity share is 100, and at a premium of 25 means each share is going to be issued at a price of 125. Then we are going to issue 10% preference shares, issue of 8% debenture. So the additional funds that the company require is 25 lakh. On this 25 lakh, company is going to get some return, and this 25 lakh to be raised, it has got three different ways to raise. One is to raise it by way of equity shares, other by preference shares, third is by debentures. Then they say it is estimated that price earning ratio in case of equity, preference share and debenture will be 20, 17 and 16. It says if you're raising the money or raising the capital by way of equity shares, then 20 will be the PE ratio. If you raise the money by way of preference shares, 17 will be the price to earning ratio. If you raise it by way of debenture, 16 will be the price to earning. Okay. Which of the above alternatives would you consider to be the best, and also reasons for choice in the first part? Okay, fine. So let's start solving this, guys. Let us first talk of how many plans are we going to look at. We are going to look at three plans. In plan 1, we are going to raise the entire money by way of equity. Plan 2, 10% preference share. Plan 3 is 8% debenture. Okay. So now, equity share capital in case of plan 1. Tell me, guys, in case of plan 1, what will be the equity share capital? Of course, after the issue of debentures, after the issue of the equity shares, what is going to be the equity share capital after the shares are issued, after the new shares are issued? Remember, it's going to be equity share capital in case of plan 1. In case of plan 1, originally we had shares of 40 lakh, right? We'll say that this should be 40 lakh, right? Plus 40 lakh plus. So additional 25 lakh is raised, but am I issuing the shares at face value? No, sir. We are not issuing the shares at face value. We are issuing at premium of 25. So each of our shares are going to be issued at a price of 25. So this 25 lakh will be divided by 125. The 25 lakh is going to be raised by the shares, and each share is going to be issued at a price of 125. This technically gives us the number of equity shares. And then I need to multiply this by 25 lakh divided by 125. Multiply this by, we're going to multiply it by 100 face value. So with a face value of 100, what is going to be the plan 1 equity capital? What's going to be the plan 1 equity capital? That's going to be 40 lakh plus this much equity share capital coming in. So that translates to 60 lakhs, right? Okay. So I'm just going to write this over here maybe, or I'll just write it in a better sense. Okay. Yeah. So 40 lakh plus, say that 25 lakh divided by 125 per share, multiplied it with 100. And this portion is the number of equity shares issued. So that's going to be 60 lakhs. Okay. Then plan 2. Plan 2 in which we have got okay, fine. So guys, if you can observe, in the question itself, we have been given 20,000 equity shares. But in case that wouldn't have been given, just if they would have said that 25 premium, still we would have been able to calculate it. So that's a way of looking at the question from a different perspective also. So even if they give you, even if they don't give a number of shares, you can still get the new equity share. Remember, the plan 2 equity share capital will continue to remain same, 40 lakh. Plan 3 equity share capital will continue to remain same as 40 lakh. In case of reserves, retained earnings, that's going to be 10 lakh for plan 2 as well as plan 3. Okay. Now, for plan 1, what is the status of reserves? So originally, we had reserves of 10 lakh, right? Plus, we are issuing 20,000 shares at a premium of rupees 25. 10 lakh plus 20,000 shares at a premium of rupees 25, because each share is at a premium, issued at a premium of 25. And remember, whatever premium you get, that will be transferred to your securities premium. So that is a part of our reserves. So this reserves is going to be 25 into 20,000 plus 10 lakhs. So that translates to 15 lakh. Okay, so plan 1, we say reserves are 15 lakh. Then 9% preference shares. Originally, we had 9% preference shares. That remains as it is, 25 lakh. In all case, in all the 3 plans, because new preference shares that we're issuing, they are issued at a different interest rate. So we'll write it separately. The 10% preference shares not issued in the plan 1, but in plan 2, you are issuing 10% preference shares at obviously the full value at face value itself, which is 25 lakh, because we are anyways intending to raise 25 lakh. In case of plan 3, there's no 10% preference share. 7% debentures is there in the plan 1 because there's a part of our existing capital structure. So 7% preference shares is 25 lakh. Then that's going to be basically there for all the 3 plans. Okay. Then 8% debentures. That's going to be there only in the plan 3 because plan 3 is specific for that. 8% debentures, 25 lakh. And then we have total capital employed. So total capital employed is going to be 1 crore 25 lakh. That's going to be 1 crore 25 lakh. Okay, that's 1 crore 25 lakh is the total capital employed. Hiral, why did we take retained earnings as reserves instead of including in equity? Hiral, here we are just taking equity share capital, not the reserves. The reserves are stated separately because this equity share capital will help us to know what is the number of equity shares in future when I want to compute the EPS. That's the reason. Okay, now going ahead, which plan do we choose? Now for that, we know we have to go till the market price per share. So first thing is we're looking at EBIT, earnings before interest and tax figure, because based on that, all other future calculations will follow. So now EBIT, earnings before interest and tax, how much is it going to be? We're stating that it should be 12% of total capital employed. EBIT should be 12% of total capital employed. So we state that existing rate of return is given as 12%. Now, irrespective of whichever plan you choose, remember your EBIT will remain same. So we can get this as simply EBIT is 1 crore 25 lakh. 1 crore 25 lakh. On that, we are getting 12% return. So that's like 15 lakh is the EBIT that we are generating. EBIT is 15 lakh. Now remember, 15 lakh is going to be same irrespective of whichever plan you choose. Whichever plan you choose, irrespective of that, EBIT is going to be 15 lakh. Then interest. Remember, interest is going to be two set of figures in certain cases, like interest 8% will be applicable only in case of plans. So now, interest, the 8% component, we are not going to have the 8% component in first and the second, but we'll definitely have it in the third plan because third plan itself is a 8% debentures plan. So 7% of 25 lakh, 25 lakh into 7%. So interest is 1 lakh 75,000. That's going to be there for both the plans, initial two plans, and of course for the last one also. And also 8% of 25 lakh we are going to have. That's 2 lakh. And after subtraction of these interests, PBT is going to be 15 lakh as reduced by 1 lakh 75,000. It is 13 lakh 25,000. Over here also it's 13 lakh 25,000. But in case of last one, that's going to be 15 lakh minus 1 lakh 75,000 minus 2 lakh is 11 lakh 25,000. On that, of course, we will be paying the tax. So 11 lakh 25,000. That's the tax rate is given as 50%. Tax rate is 50%. So tax rate, tax amount is going to be 5 lakh 62,500 and then 13 lakh 25,000 divided by 2, which is 6 lakh 62,500. Here it is 6 lakh 62,500. Since it's 50%, we can safely say that our profit after tax is also the same. That's 6 lakh 62,500 for the first plan, 6 lakh 62,500 for the second plan, and 5 lakh 62,500 for the third plan. We haven't reached the point at which we can decide which plan to be chosen because we still have the preference dividend impact to be given. So preference dividend impact that we've got to give is simply 25 lakh into 9%. That's 2,25,000. And remember that 2,25,000 is a figure that's going to be there. 2,25,000 is a figure that's going to be there for all the preferences. That is all plans, right? 2,25,000. 2,25,000. Now 10% of 2,50,000 will be there only in case of plan 2, because in plan 2 we were raising the funds by way of equity, by way of preference shares. In plan 2 we will have 2,50,000 as the preference dividend, and net profit that we are left out with for the equity shareholders is 4,37,500, 662,500 minus 2,25,000 minus 2,50,000 is 1,87,500, and in case of last one, that's 5,62,500 minus 2,25,000, 3,37,500. Why IT is 50%? Again, it's stated in the question itself. Tax rate is 50%. Okay. Fine. Now the number of shares will depend on your share capital. We have share capital 60 lakh, 40 lakh, 40 lakh. So that's going to be, the share capital is going to be 60,000, 40,000, 40,000. Right? $60,000, 40,000, and 40,000. So earnings per share will be calculated as 4,37,500 divided by 60,000 is 7.29. The first case, 1,87,500 divided by 40,000, that will be 4.69. 3,37,500 divided by 40,000, which is 8.44. So the P ratio that's stated in the question itself, that if you're going for the equity option, P ratio is going to be highest, which is 20, and then 17 and 16. So we'll consider the P ratio as 20, 17, and 16. And with these P ratios, we can also get the market price per share, which is 7.29 multiplied by 20. We expect a price over here to be approximately 145.8. In case of second one, we expect a price of 4.69 into 17 is 79.73, and 8.44 multiplied by 16, which is 135.04. So what's our final call? So our final call is the plan 1, because in plan 1, 145.8 is the market price. That's the market price that we are able to attain. Okay. So market price is 145.8. So that gives us a maximum market price that leads to that lead to wealth shareholders, wealth maximization. Okay. Fine, guys. Gomti is saying capital structure assignment showing blank when I'm downloading it or opening it. I have uploaded it. Just wait. Probably you'll get it by tomorrow, maybe. It will take some time to get approved. Okay, so which plan are we going to do? 145.8, that's the maximum price. Now, the question asks for give the reasons for the choice also. Obviously, the reason is the highest market price. Okay. Uh, but I wanted to typically look at certain numbers. See, the numbers are like, see, our rate of return that is generated, the rate of return is generated as 12% of our total capital employed, right? 12% of the capital employed. But the funds that we are raising, look at the rate of return on those. On equity shares, you are supposed to be paying 8%. And if you're, sorry, on debentures, you're paying 8%. And if you raise it by preference share, you're paying 10%. So you can look at the typical EPS figures. Look at this. In case you're paying to the preference shareholders, the EPS is the lowest because the rate of return which you're paying to your newly appointed or newly issued preference shares is 10%, and that is 10% of 25 lakh. That's also paid after on, that's paid out of the profits which are after tax. So out of after tax profits, you are paying the preference dividend. So 2,50,000. It's the preference. There's a extra preference that you're going to pay that will drag down your EPS. Whereas EPS is highest in case of 8% debentures because you are getting funds at a rate 8% and investing it at 12%. Right? So that leads to highest EPS, but probably the investors are not in favor to have a greater confidence on your business, and therefore your PE ratio is lower, and that makes the MPS as 135.04, which is a lower as compared to the first one. Okay, so that's what we have. The first question. I hope this first question is clear to you guys. Is this first question clear to you guys? Simple and clear, right? Mansha is asking what will be the formula to calculate the market price if you are analyzing financial health of unlisted company. Mansha, for unlisted company, there is something called as you compare it with a similar listed company. You look for similar listed company in the market and compare that company's P with yours. Okay, that's one way. Why P? Karthik is asking why P is always so low when the entity is a bit on the debt side capital structure, because the P ratio indicates the confidence that the investor has got. So when the investor has, when the company raises debt, confidence of investor, confidence of shareholders takes a backseat, takes a bit of backseat for a very simple reason, and that is like it just takes whenever some company takes a loan, it takes a risk. So when as the risk increases, of course, the confidence of the investors will fall. Look at any successful company, any company which has sustained till date. Take for that case Microsoft or maybe Apple or maybe Asian Paints in India or maybe Tata group of companies in India. They generally function on an optimum level of debt, or that is a debt beyond a level is not sustainable, right? And generally you'll find that Asian Paints, Apple, all this Apple Inc. and Microsoft, all these companies are having zero debt. And there the investors' confidence is highest because they see that companies have got no financial risk. There's no financial risk involved in those companies, and therefore investors generally provide a greater degree of confidence, and that confidence is reflected through the PE ratio. So higher the debt, higher the risk the company is taking, and that's where we say that it's the measure of confidence. So as higher the debt, risk is more, confidence of the investors will be lower, and they won't be ready to pay a very hefty price for the shares of those companies. Okay, fine. Shall we go for the next question, guys? I hope this is crystal clear to everyone. It is perfectly fine with everyone. Shall we go for the next question? Yep. Shall we proceed for the next question? Is financial leverage same as financial risk? Financial leverage is one of the types of financial risk, you can say. Is one of the measure or one of the types of financial risk. Hiral, okay. Shall we proceed, guys, for the next question? We are all good? Is clear? I'll be uploading this file also. I've already uploaded the ratio analysis file. This file also I'll be uploading once I complete this topic. Karthik is asking, can we say that if investor get an attitude for taking higher risk, then it will result in better PE ratio for debt inclined capital such as the return and EPS will increase in such case? It depends, Karthik, as to how much operating risk and financial risk that the company is undertaking. If the company is having already a great degree of operating risk, then taking more of financial risk is not advisable, right? If the company is like low on operating risk, then it can definitely go for greater degree of financial risk. Also, you have to balance out both of them. You have to balance out the financial risk and the operating risk. Okay, fine. Let's go for now question number 3. Yeah. XYZ Limited, maybe XY Limited, provides you with the following information: profit of 2,60,000, interest on debentures of 60 lakh. So we've got 2 lakh as some number. Now tell me, what is this profit? This profit is definitely EBIT, sir. Because when you're subtracting interest from it, that simply means that it's EBIT. And this 2 lakh is profit before tax. We have this EBIT and the profit before tax figure. Income tax is paid, profit after tax is given, number of equity shares given, earnings per share given, ruling price in market is given 25, P ratio is given as 10. Okay. Then it further states company has undistributed reserves of rupees 6 lakh. The company needs 2 lakh for expansion. This amount will earn at the same rate as funds already employed. Company needs 2 lakh for expansion. The amount will earn the same rate as the funds already employed. You are informed that a debt equity ratio higher than 35% will push the P ratio down to 8 and raise the interest rate on additional amount borrowed to 14%. You are required to ascertain the probable price of the share. Okay, this thing says we have got undistributed profits, basically reserves of 6 lakh. Company requires 2 lakh for expansion purpose. This amount will earn at the same rate as funds already employed. So I need to know what is the rate of return that we are generating as of now. You're required and also informed that if your debt equity ratio, debt to total capital, that is out of total capital, your debt, if it is higher than 35%, it means higher risk. So when it is higher risk, your P ratio will fall from 10 to 8 because of perceived higher risk. And it will raise the interest rate on additional amount borrowed to also 14%. Like If you want to take more and more debt, higher debt will require you a greater percentage. So 14% will be the interest rate on additional amount borrowed. You are required to ascertain the probable price of the share. Probable price of the share if the additional funds are raised as debt or if the amount is raised by issuing equity shares. So we have got two plans over here, by way of debt or by way of equity. So let's look at the very first thing, which is the existing capital structure. The existing capital structure of the company comprise of, bring it and minimize it a bit. Yeah. Existing capital structure of the company will consist of, see, there's a debenture component. 60,000 is the interest that you are paying, on which 12% is the rate of interest. You are having debentures to the tune of 5 lakh. Moreover, we have number of equity shares of face value each 10, amounting to 40,000. The equity share capital will be 4 lakh. And also the question says that it has got a reserves of 6 lakh. It means as of now, we have total capital employed as 15 lakh. So in our business, we have invested 15 lakh. In the current business, we have invested 15 lakh. And by investing this 15 lakh, how much are we really earning? By investing this 15 lakh, how much are we really earning? So for that, we will say what is our current return on capital employed. So return on capital employed will be EBIT upon total capital employed into 100. Current return on capital employed will be EBIT upon total capital employed into 100. We have got an EBIT of 2,60,000 on an investment of 15 lakh. 2,60,000 is the return on capital employed on an investment of 15 lakh. So multiplying it with 100 will give you 17.33%. Current return on capital employed as of today is 17.33%. So whatever money you invest in this business, that gives you 17.33%. Why is it needed, sir? Because I will need this percentage for calculating the EBIT after the funds are raised. So proposed capital structure the proposed capital structure is by way of debt or by way of equity. So first we'll say by way of debt. By way of debt, plan 1. Let's have a look at plan 1 and then we'll go for plan 2. So in case of plan 1, we already have a debt of equity of 4 lakh, reserves of 6 lakh, old debentures of 5 lakh. And how much do we need right now? We need an additional capital of 2 lakh. We need an additional capital of 2 lakh. So that additional capital is raised. Now, when you raise this additional capital, your total capital employed becomes 17 lakh. Now, you need to check over here, what is our debt to total capital? So over here, debt to total capital, debt is these two, 5 lakh old debentures and 2 lakh new debentures. So total debentures that we have outstanding is 7 lakh on 17 lakh. So out of 17 lakh, we are having 7 lakh as the debenture and we get the debt to total capital employed, which is 41.18%. And say the question over here says that if your debt to capital ratio is higher than 35%, your debt to capital ratio is higher than 35%, then the rate of interest that will be applicable to you on the new loan will be 14%. It will be 14%, right? So 7 lakh divided by 17 lakh is going to be obviously greater than 35%. So that will lead to two implications. One implication is that your rate of interest will be 14%. Another implication will be that your PE will fall down to 8. That's a plan 1 for debt. Okay, that's a plan 1 for debt. Now going to plan 2. So in plan 2, we are going to raise it by way of equity. Okay. Now, by way of equity, when we want to raise it, see, the funds that we want to raise is, sir, 2 lakh. The amount of fund that we want to raise is 2 lakh. Each equity share is having a market price of 25. So, sir, for 2 lakh, how many shares will I be required to issue? 2 lakh divided by 25. 2 lakh by 25, which means 8,000 shares. Now, these 8,000 shares, we can say, we distribute it as I will be receiving 25 per share. I'll be receiving definitely 2 lakh. But out of that 2 lakh, I need to decide how much will be going to equity share capital and how much will be going to the securities premium. So 8,000 multiplied by 10 per share. 8,000 multiplied by 10 per share, that will be 80,000. So the equity share capital will be 80,000. Securities premium will be, so 25 is the share price. Each share is 25, right? So out of that, you say 10 is the face value. So definitely 15 rupees that you're charging extra, that's a securities premium. So 1,20,000. It means the total out of total 2 lakh, 80,000 goes to equity share capital, 1,20,000 goes to securities premium. So we say over here that our equity share capital will become original 4 lakh plus this 80,000. Reserves will be 6 lakh plus 15 per share or 1,20,000 will be the securities premium. And the old debenture continue to be same as 12%. So we get a total capital employed of 17 lakh. But here, if I just check that what's the debt to total capital employed ratio, because that's a significant number which will determine what will be the interest. And of course, this interest is not going to change, but what is relevant for us is the P ratio, or the price to earning ratio. So 5 lakh is our old set of debentures upon 17. So 5 lakh divided by 17 lakh, that's going to be 29.41%. So debt to total capital employed, we say that it is 29.41%. And since it is lesser than 35%, since it is lesser than 35%, so we will say this is going to be just 10. That is, the P will continue to be 10 only. Okay, great guys. Next, EBIT. Let's look for which plan is better. Now, how much EBIT are we going to get? So earlier, on an investment of 15 lakh, we used to earn 2,60,000 as the EBIT. And we have computed that the rate of return of this business entity, is 17.33%. We say 17 lakh into 17.33%. That translates to 2,94,610. That's going to be same for both the plans. That's not going to be any difference between them. Then we need to subtract the interest. So interest over here, it will be two set of interest. First, on 5 lakh, on this 5 lakh, we say that there's an interest of 12%. There's an interest of 12%. Yes. Okay. Anyways. Fine. So we get EBIT of 2,94,610. From that, we are going to subtract the interest. Remember, interest is going to be two things. One, interest is going to be on 12% on 5 lakh and 14% on 2 lakh. So in total, the interest will be subtracted. The profit before tax figure will be obtained accordingly. And then you subtract the tax, you obtain the PAT, you come at number of divided by number of equity shares, earning per share, multiply it with P, and then you get this market price per share. And of course, we can say that the funds should be raised by way of equity shares, as that's leading to the maximum market price per share. Okay, is this question well understood, guys? Question number 3 from the handout that I have given. Is this well understood? Is this question well understood, guys? Yep. Wait for your answer till that point of view. Yep. Yes, understood, guys. Okay. So we have done question 2 and question 3 from the handout. Let me take the queries. Karthik says, "Sir, is it always a case that is it always a case that higher the equity, higher the market price?" Need not be, Karthik. Uh, Equity, share price, market price, it depends on the P ratio. So P ratio is the kingmaker over here, which will let you know whether it is no, whether that will lead to higher market price or not. Tanvi is asking, is we have to assume that equity shares are issued at market price? Yes, there's no other feasible alternative, right? There's no other feasible alternative, Tanvi, because that's the best that you can think of. Because we have to issue the shares definitely at a market price only. Okay. Any other queries, guys? Oh, we have got this working. The fund should be raised by way of equity shares. We have assumed. Now, before we go for the next point discussion, just confirm, guys. Are we all aware about something called as break even point? Are you guys aware about break even point? Yes or no? Do we know something called as break even point? Break even point. Are you aware about break even point? No profit, no loss situation. Okay. What is that break even point? What if I say that my break even point is, let's say, 60,000? What does that mean? If I say that break even point, uh, you're saying no profit, no loss. But when I say the break even point is 60,000, what does that mean? 60,000. What is that 60,000? Okay, I know that break even point is the point at which no profit, no loss. All fixed costs are covered at that point. That's okay. But what do we mean by that 60,000? Let's say break even point is 60,000. What is that 60,000? That 60,000 is, guys, the amount of sales, right? Correct, Raghun. If my sales goes below 60,000, I will not be able to recover my fixed costs, right? Or that's the break even point. So we say uh, break even point is that level of sales at which you are having no profit, no loss. Okay. Break even point is that level of sales at which there is no profit, no loss. Okay. So remember, break even point is not that point. Don't come to that point. It is what? It is the sales. It is a level of sales at which there is no profit or no loss. We have to discuss in this chapter something called as financial break even point. You might have learned break even point as some sales value, but over here we are going to talk about something called as financial break even point and financial indifference point. What are those points? We will take it up, guys, after the break. So let's take a break of 10 minutes. And after that, we'll take up the point of financial break even point and financial indifference point. Okay, so let's take a break of 10 minutes, guys. Welcome back, guys. After the break, uh, let's continue. Before the break, I just gave you a hint about what we'll be discussing right now. I said that we were discussing something called as break-even point or financial break-even point. As you rightly said, break-even sales, break-even point is the level of sales at which profit is zero. Is the level of sales at which profit is zero. Similar to this, we have something called as financial break-even point. So, financial break-even point is what? It is the EBIT at which net profit for equity shareholders is zero. Okay. So, say EBIT, its financial break-even point is that level of EBIT at which net profit for equity shareholders is zero. So, to discuss that, we'll take up a typical example. Okay, let me just take an example for you. Okay. Yeah. So, as I said, a financial break-even point is EBIT at which net profit for equity shareholders is zero. So, let us consider how do we compute this EBIT at which our net profit for equity shareholders is zero. Okay. For that, let us take some numbers. Suppose EBIT over here is, let's say, 35,000. Okay. Interest that we pay is, let's say, 10,000. Profit before tax translates to 25,000. On that, you pay 40% tax, which is 10,000. Then your profit after tax is 15,000. And now, if I say that you're paying a preference dividend of 15,000, your net profit for equity shareholders is going to be zero. Now, we observe that EBIT of 35,000 is causing a net profit for equity shareholders to be zero. EBIT of 35,000 will cause the net profit for equity shareholders to be zero. So, if I ask you, so suppose I take this 35,000 to a higher level. Suppose I make it as, instead of 35, I make it as 40,000. What will the impact on net profit for equity shareholders? What is the impact on net profit for equity shareholders? Say interest will continue to be 10,000, PBT of 25,000, tax will be not 25, sorry, PBT is going to be 30,000. Tax is simply going to be like 40%. So 40% of this is going to be 12,000. Profit after tax is 28,000. We have a preference dividend of 8,000, that's 18,000. Preference dividend of 15,000. So we are left with a net profit for equity shareholders as 3,000. Similarly, if I tell you, let me just reduce this 35,000 by another 5,000 so that my EBIT becomes 30,000. Interest will continue to be 10,000. Remember, whatever be the level of your EBIT, interest will remain as and where it is supposed to be. So interest of 10,000, PBT is going to be 20,000. Tax at the rate of 40% will translate to 8,000. We have a PAT of 12,000, but then, sir, preference dividend payable is 15,000. We end up with a net profit for equity shareholders being a negative 3 lakhs. So, what interpretation can we do? So, we can say financial break-even point is the EBIT at which net profit for equity shareholders is zero. Right? Net EBIT at which net profit for equity shareholders is zero. But that also implies that if my EBIT is less than financial break-even point, right? So let's say this EBIT 30,000, which is lower than this 35,000, right? 30,000 is lower than 35,000. That's negative net profit for equity shareholders. And when EBIT is greater than financial break-even point, 35 to 40,000, that's positive net profit for equity shareholders. When your EBIT is less than financial break-even point, we have got negative net profit for equity shareholders. When EBIT is greater than financial break-even point, then we have positive net profit for equity shareholders. Right, guys? Okay. So let's visualize it a bit. You can say this is the typical visualization. This x-axis indicates the level of EBIT. X-axis indicates the level of EBIT that we have. And the net profit for equity shareholder, it will keep on increasing at a consistently rate, the level of sales. As the EBIT increases, we find that net profit for equity shareholders will also increase. But there is going to be a break-even point. If your EBIT is in this range, your EBIT is in this range, that is, if your EBIT is less than financial break-even point, then the net profit for equity shareholder figure is a negative figure, or it's a loss. And when EBIT is in the higher range, net profit for equity shareholders will be positive. Net profit for equity shareholders is going to be a positive figure. Right? The financial break-even point is the trigger point beyond which any business entity would like to be there. Any business entity would like to be above this level of EBIT, because it is only when the level of EBIT is beyond this, you will get a positive net profit for equity shareholders. Okay. So just to state, sir, what's the financial break-even point? It is that level of EBIT at which net profit for equity shareholders is going to be zero. So net profit for equity shareholders is going to be zero. It means if I have a EBIT more than financial break-even point, will I have positive net profit for equity shareholders? Yes. And if it is lower than that, it will be negative. So you can say this is how it typically looks like in graphical. So now we are really interested to know, sir, how do you get this 35,000? How do you know that a typical level of EBIT is the break-even point? How do we decide that a typical EBIT is a break-even point? Right. So for that, let's try to derive the formula for financial break-even point, guys. Okay. Okay. So guys, after a target over here is that net profit for equity shareholders should be zero. Okay. So let me take this preference dividend figure as X. Okay, let's take this preference dividend figure as X. So if I want my net profit for equity shareholders to be zero, if I want that net profit for equity shareholders should be zero, how much should be PAT? Can do the recalculation, can do the backward calculation. If you want your net profit to be zero, how much should be PAT? So PAT should be X, because only after subtracting X from X, I'll get zero. So my profit after tax should be X. Perfect. Fine. Now, this is where we did a backward thing, that is from net profit for equity shareholders to profit after tax is X. Okay. Then for EBIT, interest, PBT, and tax, how do we go about these things? So let's say if I tell you tax rate is at the rate of maybe 30%. Okay? Tax rate, if it is at the rate of 30%, we can say, sir, if my PBT is 100, tax would be 30, PAT will be 70, right? If my PBT is 100, my tax should be 30, and my profit after tax should be 70. If I ask you, what should be this figure then? Can we do the backward calculation, the cross multiplication thing? We can get this as, sir, 100x upon 70, 100 into x upon 70, right? We can get it by cross multiplication as 100x upon 70, right? Or I can simply say this as, sir, 100x upon 70 can also be stated as 100 upon 0.7, because that's just 0 getting cancelled and 100 divided by 10. So I can state it as x upon 0.7. Yeah. I've taken this tax rate just for the sake of purpose of illustration purpose. It can be 30, 40, anything. We get this as x upon 7. Now let's say the interest amount is y. So the interest amount is y. Now tell me, what should be the EBIT figure? The EBIT figure will be x upon 0.7 plus y. Correct? It should be x upon 0.7 plus y. Because when you subtract from EBIT, you subtract interest and you get this, right? So when you do a backward calculation, it should be like this. So financial break-even point is x upon 0.7 plus y. If I tell you what is this x, so x was preference dividend. Upon what is this 0.7? So this 0.7 is 1 minus 0.3 plus y was the interest. That's actually preference dividend upon. So 0.3 is the tax rate, because 30% was the tax rate. So it is preference dividend upon 1 minus t plus interest. That's the financial break even point. Financial break even point is preference dividend upon 1 minus t, preference dividend upon 1 minus t plus interest. That's the financial break even point that we are talking of. Preference dividend upon 1 minus t plus interest. That's how we are going to derive it. We can also apply the formula over here. See, over here we had the interest as 10,000, preference dividend as 15,000, right? Let me just apply it over here. Financial break-even point is equal to x was preference dividend. So preference dividend amount was 15,000. 15,000 divided by 1 minus tax rate was 40%. So 0.4 plus interest amount was 10,000. Just check it out. This calculation. 15,000 divided by 0.6 plus 10,000. That's coming out to be exactly 35,000 that we have taken up over here. Okay. 35,000 is derived on these lines, financial break-even point. Yep. So we need to remember this formula for financial break-even point. So it's preference dividend upon 1 minus t plus interest. Is this formula very clear to you guys? Is this formula perfectly clear to you? Fine if you don't understand the derivation, but you need to remember this formula. Okay. Now to make this even more clearer, let's look at illustration of question number 6 from our handout. Okay. Yes, Prabhas, what are you trying to say? Yes, your queries are reaching me, but tell me what are you trying to say? Question 6, guys. Hypothetical Limited is in need of 1 lakh to finance its increased net working capital. It needs 1 lakh to get to finance its increased net working capital. Finance manager of the company believes that its various financial costs and share price will be unaffected by the selection of particular plan. Since a small sum is involved, so the finance manager says that its various financial costs and share price will remain unaffected because it's a very meager amount. Debentures will cost 10%, preference shares 11%, equity shares can be sold for 25 per share. Tax rate is 35%, and we are looking at 3 financing plans. The 3 financing plans are 100% equity, second is 30% equity, 10% preference shares, 60% debentures, and the third financing plan is 50% equity shares, preference share 20%, debentures 30%. And the question asks us, determine the financial break-even point. Which plan has greater risk? Assume EBIT level of 50,000. Okay. Determine the financing break-even plan. Which plan has a greater risk? And we have to assume an EBIT of 50,000. Now, how do we know which plan has a greater risk? Which plan has a greater risk? Now tell me, in general sense, which plan do you feel has a greater risk? The plan with higher break-even point or lower break-even point? Which plan do you feel has a greater risk? A plan with higher break-even point or lower break-even point? Of course, it's a plan with a lower break-even point. The plan which gives a lower break-even point, that's the best one. So if company does not have any debt or preference share, its BEP will be 0. Yeah, Prabhas, correct. Shrey is asking what would be on y-axis of the graph. On y-axis, you have just the amount which denotes for the net profit for equity shareholders and the EBIT. Or you can also say on y-axis, you can also have the EPS also. Either of it. The graph will be similar. Okay, so we just now said that the plan with lower break-even point will be less risky or it will be more safe, because understand, if one plan has a break-even point of 10,000, the other plan has a break-even point of, let's say, 30,000. If one plan is having a break-even point of 10,000, the other is having a break-even point of 30,000. Which one is the best one, or which one is having a lesser risk? It will be a plan which is having, 10,000 is 10,000 break-even point, financial break-even point will be having a lesser risk, because it's easy to attain break-even point over here, because as soon as your sales increases 10,000, as soon as your sales increases 10,000, you will start making profits, right? As soon as you start, enter the profit, it's easy for you to enter the profit zone. Remember, more than 10,000 will give you profit. So when your sales crosses 10,000, you will start making profit. Whereas in this second case, you will require your sales to be reaching 30,000 so that you start making profits. Before 30,000 sales, you are into the loss territory. Okay, therefore we look for the plan which has got lower financial break-even point to understand the risk involved in it. Okay, so let's look at this question number 6, guys. Yeah, question 6. Okay, so we need 1 lakh as the equity capital, and the plans are 3 different plans. So we can say equity plan 1 lakh, second plan is 30, 10, and 60. Third plan is 50, 20, and 30. Based on these 3 plans, we know that debentures is going to cost us 10%, preference share 11%. So in plan 1, we don't have any preference dividend or interest. But in plan 2, we have a preference dividend as 10,000 into 11%, that's 1100, and 60,000 into 10%, that's 6,000. In plan 3, that's 20,000 into 11%, 2,200, and 30,000 into 10%, that's 3,000. So preference dividend is 1100, 2,200. Interest is also available. With these figures, uh, I want you to calculate the break-even point, guys. Calculate the financial break-even point for these 3 plans. Give me the financial break-even points, guys. Come on. Give me the financial break-even points over here for these 3 points. Give me the financial break-even point for these 3 plans. Yeah, guys. So for plan 1, break-even point is 0. Tax rate. Karthik, tax rate is given at 35%. Karthik, tax rate is 35%. Okay. Plan 1, it is 0. Okay. Plan 2, 7692. Okay. Get me the break-even point for plan 3 also. Okay, plan 3, 6385. Okay, just check out the numbers, guys. For plan 1, it should be 0. For plan 2, it should be 7692. And for plan 3, it should be 6384, 385. Got it? Right? I hope all of you have got the financial break-even points. Now, the question chooses us determine the financial break-even point. That's done. Which plan has greater risk, assuming a EBIT level of 50,000? Now, which plan is having a greater risk, guys? Tell me. Out of these three plans, which one is having a greater risk? I just discussed some criteria to decide the risk level of risk. Plan 2? Yes, definitely, sir. Plan 2 is having a greater risk because you understand what is the level of EBIT required for positive net profit for equity shareholders. We say even if you earn 1 rupee EBIT in the first case, you will start making profits. But for plan 2, you need to have 7692 as your EBIT, after which you will start making profits. And then 6384.62, that's the level after which you will start making profits. Right? So, of course, we say the second plan is the most risky one because there it is having the highest financial break-even point. Okay. The highest financial break-even point. Is it fine? Perfect, guys. Now let's go for the next concept for the day, or possibly this will be the last concept for the day because that will beyond that we'll be doing some practical questions. So the next concept, guys, today is something called as indifference point. I hope you have learned something called as indifference point, guys, in costing. You've learned something called as indifference point. So can you tell me what's indifference point? What's the indifference point? Anyone? What do you understand by indifference point? What do you understand by indifference point? Yeah. Anyone? Indifference point? No? Okay, let me come up with it. Indifference point, guys, understand we're talking of indifference point is that level of EBIT. It's that level of EBIT for which two plans are going to give the same EPS. The indifference point is actually that level of earnings before interest and tax for which both the plans are going to provide the same level of EPS. Okay. So our idea is we want to know, sir, what should be this EPS? What should be this EBIT? So that EPS of two plans are equal. EPS of two plans are equal. Right? We want to know what is this EBIT level at which EPS for both the plans is same. At which EPS for both the plans is going to be same. So now if I say, sir, I don't know what is that level of EBIT at which EPS is going to be same. So let us assume that EBIT to be X. Right? So it's that, let's say that at a level of EBIT, at a level of this, we say that some level of EBIT, we'll find that EPS should be equal. So now EBIT is X. So interest, let us say interest is 30,000. If I say interest is 30,000, ideally, sir, profit before tax figure will be X minus 30,000. X minus 30,000. Tax at the rate of 50%. So that will be 0.5x minus 15,000. That's also 0.5x minus 15,000. It will give us a PAT of 0.5x minus 15,000. Preference dividend. Let's say in plan 1, there's no preference dividend, but in plan 2, we have 40,000 as the preference dividend. So my net profit for equity shareholder will become 0.5x minus 15,000 as it is. And in this case, it's going to be 0.5x minus 40,000 and this typical, one second, let me just change it. The interest, one second, interest we cannot see it. Let's say interest as in this second plan as 10,000. Becomes 10, then this becomes 5,000. Also 5,000, and this becomes like 0.5x minus 45,000. Number of equity shares, let's say here we have 12,000, and in this case we have, let's say, 10,000. So of course the EPS figures that we are talking of is going to be 0.5x minus 15,000 upon 12,000 is equal to 0.5x minus 45,000 upon 10,000. Let's just solve it simultaneously. You can just cancel three numbers from either side. So it's going to be 5x minus 1,50,000. We're doing just the cross multiplication, equal to 0.5 into 12, that's 6x minus 45,000 into 12. 45,000 into 12, which is 5,40,000. Okay. Then you take x on one side and the other numbers on the other side. There is as 5,40,000 minus 1,50,000 equal to x. So x will be 5,40,000 minus 1,50,000. That becomes 3,90,000. Right? So I just want you guys to just do one exercise. Let's say for plan 2, if you begin with 3,90,000 as the EBIT. For plan 1 also, you begin with EBIT of 3,90,000. Give me the amount of EPS for both the plans. We just computed something X as 3,90,000. And remember, this 3,90,000 was X, at which we said that the EPS should be same. Right? So do one thing, start with this 3,90,000 and try to give me the EPS over here. Try to give me the EPS under both the plans. Verify, are they same or are they different? Just verify, are they same or are they different? Start with EBIT of 3,90,000. Calculate, calculate it up to EPS and check whether the EPS under both the plans is same. Check it, guys. Yep. Let's see if the EPS is same. Is the same? Is the same? It should come out to be 15 in both cases. It should come out to be 15 in both cases, right? Are we getting 15, everyone? 15 as the EPS under both the plans. It's same. Perfect. Great, sir. Now, let's come up with a formula which will directly give us the value of EPS. So for that, see, we can compute EPS as X, which is the indifference point. From that, we subtract the interest. When I subtract interest from EBIT, we get profit before tax. From that profit before tax, we subtract the tax amount. Right? So from that, when we want to say that tax amount will be some tax rate multiplied by the PBT amount. Remember this X minus interest itself, the profit before tax figure. So X minus interest into tax. From that, we subtract preference dividend and then we divide it by number of equations. This is the same expression that we did over here. This is the same expression that we did over here. That's X minus interest minus tax minus preference dividend. So we can say, let's take this X minus interest as a common term. X minus interest as a common term, and inside we'll have 1 minus T. X minus interest into 1 minus T minus preference dividend upon number of equity shares. X minus interest into 1 minus T minus preference dividend divided by the number of equity shares. Yeah. So that's the EPS. Now, suppose I tell you that there are two plans, plan 1 and plan 2. In plan 1, interest payable is 50,000. In plan 2, interest payable is 40,000. Preference dividend is 1 lakh in plan 2. Number of equity shares is 3,000 in plan 2, 5,000 in plan 1. So, EPS of our plan 1 will be X minus interest of 50,000 into 1 minus 0.3. That's the tax rate, assuming the tax rate will be 0.3 minus 0 because there's no preference dividend. And over here, we say that it's X minus 40,000. 40,000 is the amount of interest into 1 minus T minus a preference dividend of 1 lakh. Okay, preference dividend of 1 lakh divided by the number of shares of 3,000. Can you equate these two expressions? Equate these two expressions, guys, EPS 1 and EPS 2, and get me the value of X. Equate these two expressions and get me the value of X. Yes, guys. We're getting this x. Solve it same way as we have did this. Solve these to equate this and get the value of x. Okay, Hitesh is the first one to get the answer. 1,83,500. Okay, let me see. Oh, it's not that, Hitesh. So that's x minus 50,000 into 0.7 divided by 5,000 equal to x minus 40,000 into 0.7 divided by minus 1 lakh upon 3,000. So we get this cancelled. 3 will be multiplied this side, 5 will be multiplied on the other side. So we have this typical 3 into 0.7, that's 2.1. So 2.1x and 2.1 into 50,000 will be 1,05,000 equal to x minus 40,000 into 0.7 minus 1 lakh into 5. So we have it as multiplied on the other side. 5 into 0.7 will be 3.5. 5 into 1 lakh will be 5 lakh. So 3.5 further multiplied by this 3.5x minus 1,40,000 and then subtracting it with 5 lakh. Okay. So 2.1x minus 3.5x, then 1,05,000 the other side, 5 lakh also negative, and this is it. We get an entire negative, and x value should be 3,82,143. 3,82,143. Getting it? I think Isha is the one who have got it correct. Has got it correct, right? Yeah, Isha. Got it? 3,82. Now understood. Okay. 65,000. No, it's not 65. 3,82,143. Perfect. Did we get it? Anyone else also got it? X is 3,25,000. No. Simple arithmetic, guys. You guys are making some blunder in the calculations. X is 3,82,143. Perfect. Fine, yes. Let's try to do now question number 11. Let's try to solve this question number 11. Yep. Key information pertaining to the proposed new financing plans of Hypothetical Limited is given below. So two plans are being considered. First plan comprises of 15,000 equity shares of 100 each, 12%, 25,000 shares of rupees 100 each, preference share, 5 lakh at a coupon rate of 0.1 or 10% basically. The second plan is 30,000 equity shares of 100 each and debentures 15 lakh at a coupon rate of 0.11 or 11%. Assuming 35% tax rate, first is determine two EBIT EPS coordinates for each financial plan. Determine the indifference point and the financial break-even point for each financing plan. Which plan has got more financial risk and why? And indicate over the EBIT range, if any, one plan is better than the other. And if the firm is fairly certain that EBIT is going to be yeah. So if firm is certain that EBIT is going to be 12,50,000, then which plan would be recommended? Okay. So plan one, we say equity share capital is going to be 15,000 into 100, 15 lakh, 30,000 into 100, which is 30 lakh. Okay. Coupon rate, Hiral, coupon rate means the rate of interest paid on the preference share of the debenture. Okay, so preference share capital is at a 12%, 25 lakh, and 5 lakh at the rate of 10%. Plan 2 is going to be 15 lakh at the rate of 11%. 15 lakh at the rate of 11%. Okay, the total we have 45 lakh as the capital employed. Okay, so in case of first plan, there is the interest. In case of first plan, the interest is going to be 5 lakh into 10%, and in second plan is going to be 15 lakh into 11%. So 5 lakh into 10%, 50,000, 15 lakh into 11%, it's 1 lakh 65,000. Preference dividend is 25 lakh into 12%, that's 3 lakh. Based on this interest and preference dividend, can you tell me what's the financial break even point for both the plans? Calculate the financial break even point. Pooja, these are the questions from the books itself, from the module itself. You can put it, you can look into the module also. These are the same questions from there. And Pooja, that chapter entirely capital structure has got two parts. So we are into the first part of the chapter. We'll be covering the next part in the next session. So after that, you can look into the illustrations from the book. Okay. So you can look at the solutions or the illustrations later on once we complete the second. Anyways, we have a revision session also on ratio and this thing. At that time, I'll be taking up the module questions. Yep. Give me guys financial break-even point for both the plans. I've given you interest and preference dividend. Provide me what will be the break-even point, financial break-even point for plan one and plan two. Give me the financial break-even point. Plan one, it is 5,11,538. Raghavan is saying plan two is 50,000. Plan two is 50,000. Now, plan one, it will be 50,000 plus 3 lakh upon 1 minus 0.35. That's the tax rate given in the question, 35%. And over here, it should be 1 lakh 65,000. So plan one will be 4 lakh 61,538, and this will be 1 lakh 65,000. And how did you get 5 lakh 11? I suppose you have taken tax rate as 30%, correct? That's why you're getting a different answer. Talking of the risky plan, which one is risky? So for that, obviously, we need to look at the break-even point. Did we get these numbers? Just re-verify. 4 lakh 61,538 and 1 lakh 65,000. Are you getting these numbers? Then 1511. Is it? Take the tax rate of 35%. Taking tax rate of 35%. Still, you are having that number? Check. 3 lakh is the preference dividend divided by 0.65 plus 50,000. Okay, okay, fine, guys. This is the wrong one. Correct is 5 lakh 11,538. Perfect. Part 1, it is 5 lakh 11,538. Okay. Five lakh 11,000 coming. It is, yeah. Okay. This one's more risky. Now, based on these figures, interest, preference, dividend, can you guys calculate the break-even point now? Can you guys calculate the break-even point for both the plans? Oh, sorry, break-even point is done. Indifference point, my bad. Can you guys calculate the indifference point over here for both the plans? Get the indifference point. The indifference point for plan 1, we can say it is x minus 50,000. The indifference point minus 50,000 into 0.65, because 35% is the tax rate. So 1 minus t, minus 3 lakh as the preference dividend. And on this side, similar equation. Then solve it to get the value of x. Get the indifference point, guys. Yep. Give the indifference point. Compute the indifference point, guys. Yep. Waiting for your answers. Solve it properly. 0.65 multiplied on this side, 0.65 into x, 0.65 into 50,000 minus 3 lakh. And anyways, 15 and 30,000, you can just cancel it. Tax rate is 0.35. So on solving that, 2 further multiplied by this, solving that, you should get a indifference point as 8,58,076. Let's verify, are you getting this 8,58,076 as the indifference point between both the plans? So 0.65 minus 3,32,500 into 2.65 minus 1,07,250. We have 0.65 into 2, and this further multiplied by 2 equal to 0.65x minus 1,07,250. 1.3x minus the X term, which is 0.65 on the other side. You have 6,65,000 minus 1,07,250. Subtracting this and then further dividing this, we get the indifference point as 8,58,076. Please verify these answers, guys. Eight lakh 58,076. Yep, getting it. Perfect. Fine. Now let's understand very important concept now. Very easy, but yes, important one. See, we have this indifference point of 8,58,076. On x-axis, we are definitely plotting the EPS. Sorry, on the y-axis, we are plotting the EPS. Understand that for both plans, we had the indifference points and we had financial break-even points also. Plan 1, it was 5,11,538. Maybe this is 5,11,000. The indifference point 5,11,538. This is the other plan 2 thing, which is 1,65,000. And as per our procedure, we said that our net profit or EPS will become positive only after crossing this break-even point. So both of them were break-even point. And then we have a indifference point available for us, which is this. The indifference point is 8,58,076. An important point to be looked at over here is before the indifferent point, plan 2 was dominating. Can you see? Before indifference point, this was plan 2 line, right? The plan 2 line was on the top. After the indifference point, plan 1 line becomes the superior line. Right? Because I have drawn as per the numbers that we have obtained. So as per the numbers, we observe that plan 2 is superior below indifference point. Plan 1 is superior above indifference point. So we say if plan is less risky, so if the plan is less risky, we should always say that if your EVIT is less than indifference point is suitable. Because remember, plan 1 was high risk. Plan 2 was less risk. So if your EVIT is less than indifference point, and if your plan is less risky, then you should choose that. Or basically, I can say, if you're looking for a plan which is less risky, that is suitable only if your EBIT is below the indifference point. And if your EBIT becomes more than indifference point, then you should take more risk, right? Because it's beneficial to take more risk when you have a greater degree of EBIT. Remember the capital gearing ratio. If you want a greater speed, you need to have a greater degree of leverage. So if the plan is less risky, we say that EBIT less than indifference point is suitable. And if the plan is more risky, then as you say, plan 1 was more risky, that is suitable only if it is beyond the indifference point. So if you calculate, EPS at different levels, like I'll give you a task today to complete it as a part of homework. You can take down this task from here. Okay, anyways, I'll be uploading this on the portal still. We'll talk of EBIT levels, different EBIT levels. One is obviously at 8,58,076. Other is going to be lower than 8,58,000, let's say 8 lakh. And one is going to be higher than that, let's say 9 lakh. For these level of EBIT, for plan 1 and plan 2, at both this level of EBIT, for plan 1 as well as plan 2, I want you to prepare an income statement. So EBIT, from that interest is subtracted, so you get PBT. From that tax is subtracted, so that you get profit after tax. From that you subtract the preference dividend, you get net profit, and then divide it by number of equity shares. That will give you EPS. So basically, I want you to do this. I want you to complete this table for different plans at different levels of EBIT. Okay. So at 8 lakh EBIT, check what is the EPS in plan 1 and in plan 2. At 8 lakh 58, what is the EPS? And in 9, in case of 9 lakh EPS, what's the 9 lakh EBIT? What is the EPS? Okay. This is a task for you which you have to complete for the next class. So the next class we'll discuss about this, and then we'll go for the next part of our chapter, which is the capital structure theories, which involves sort of debate discussion. Okay. Prabhas is asking what's exactly the difference between indifference point and financial break-even point. Indifference point is always between two plans. Financial break-even point is for a single plan. Each plan will have its own break-even point. Indifference point is always between two plans. Indifference point is the level of EBIT at which EPS of two plans will be same. Financial break-even point is that point where your EPS is zero for that plan. Okay. Fine. I've uploaded this on the portal, guys. The questions are available on portal. I'll be uploading this notes also, so that you can have a look at it and complete this table. Okay, we'll discuss about this more in the next sessions, the upcoming sessions, guys. Till that time, let's just stop here for the day, and we'll take up the session forward in Saturday's session. Okay. Let's stop here, guys. See you in the next class. Bye bye and take care.